Typically, we refer to the Parabolic SAR as simply SAR. It stands for Stop and Reverse and offers a different approach to managing protective stops, trailing stops, and even exits for trades, so it's extremely practical. One of the advantages of the SAR is that it is a visual tool that appears as a series of dots on your chart directly relating to the price action. Think of these dots as your dynamic guardrails. They help you decide where to set your stop losses as the market moves. When these dots switch positions from above the price to below it, or vice versa, it signals a potential reversal in price direction, guiding you to either exit or enter new trades. If you were a pilot, this would be like having a co-pilot in your trading journey, alerting you to changes in the flight path. Now let's get into how to use the Parabolic SAR. The Parabolic SAR appears as a series of dots on your trading chart. When these dots flip positions, moving from above the price to below it, they signal a potential bullish turn, suggesting it might be a good time to enter a long position or exit a short position. Conversely, when the dots move from below the price to above it, it suggests bearish momentum, signaling an exit for long positions or an entry for shorts. For stop settings, the Parabolic SAR is particularly straightforward. When you enter a long position, you can place your stop loss at the dot level below the current price. As the price rises and the dots ascend, you move your stop loss up to the new dot level, effectively using it as a trailing stop that protects gains as your trade becomes more profitable. For a short position, it's just the reverse. Set your stop loss at the dot level above the current price and adjust it downward as the dots descend with falling prices. Now let's get to the advantages and disadvantages of the Parabolic SAR. The first advantage is dynamic nature. The dynamic adjustment of stop levels helps lock in profits while still giving the trade room to grow. It's like having a safety net as the market moves in your direction. The second advantage is simplicity. Its visual simplicity makes it easy to interpret and apply even for beginners. Now the disadvantages. One downside is that in markets without a clear trend, the Parabolic SAR can produce whipsaws, leading to frequent position changes and potential losses from too many exit and entry signals. Again, this highlights why it is so important to learn how to properly identify the trend via several tools of technical analysis. And the best way to identify the trend and forecast financial markets is the Elliot Wave principle. If you're interested in mastering Elliot Wave analysis, we have a fantastic opportunity for you. Join our exclusive Elliot Wave 2-week intensive. In this program, we will dig deep into every concept, go through real market examples, the rules and the guidelines, and you'll get the opportunity to get your charts reviewed by Professor Aldo Lagrutta, a certified Elliot Wave analyst. It's a hands-on training designed to teach you how to forecast any market with confidence in just 2 weeks or less. If you're ready to take your skills to the next level, click the link below in the description to secure your spot. Now, the other disadvantage of the Parabolic SAR is the delayed entry and exit. Since it reacts to price movements, there can be a delay in the signal, which sometimes means missing out on optimal entry or exit points in very volatile markets. Now, let's take a look at this example before we finish this lesson. Let's say that we are watching this pair and we are waiting for the trend line to be broken so we can sell. Price has managed to break the trend line at around 203.60. That's where the first close occurred after the penetration of the trend line. So let's say that we enter the trade at that place. Where do we put the stop? Well, let's look at the position of the SAR above the bar. it's around 206. That will be our initial protective stop. Thereafter, no matter what prices are doing, we trail the stop along with the SAR. Notice how the SAR would have kept us in that trade all the way down to 195.90, but it would have been stopped out at around 197.80. At that point, the SAR moved from above the bars to below the bars, indicating that we needed to exit the position. Obviously, not all examples work that way. In fact, you can see on the left portion of the chart, while prices were above the trend line, that there were several whipsaws. But this is something that would happen with all indicators.